Welcome to The Explainer. Today, we're diving into something that a lot of people find, well, a little scary: the stock market. Our mission is to strip away the confusion and show you how it all really works, from the ground up. Let's jump right in. This quote just nails it, doesn't it? You see this incredible machine with all these blinking lights and you think, where do I even start? But here's the good news. It is not rocket science. It's just a system with its own rules and its own language. And by the end of our time today, you're going to be speaking it fluently.
So here's our game plan. First, we're going to deconstruct the market, piece by piece. Then we'll look at your actual gateway into trading. We'll walk through a typical day in the life of the market, and finally, we'll meet the major players and forces that make it all move.
Okay, let's get to it. We're starting at the very beginning with the absolute fundamentals. These are the building blocks of everything else, the stuff people often assume you just know.
The single most important concept to get your head around is the share. So what is it? It's simply a tiny, tiny piece of a company. When you buy just one share of, say, Reliance Industries, you're not just placing a bet. You literally own a sliver of that entire business.
Now, every share has two different values, and this is a really key distinction. First, you've got the face value. Think of this as an old, historical number, kind of like the price printed on the original paper certificate. For a giant company like Britannia, it might be just 2 rupees. But then you have the market value, and that's the number that matters. That's what people, right now, are willing to pay for that same share. And in Britannia's case, that's over 4,000 rupees. The difference is just huge.
So where does that 4,000 rupee price come from? Here's the best way to think about it. The entire stock market is just one giant, non-stop auction. That price you see on your screen, it wasn't set by some guy in a back room. It is simply the last price a buyer and a seller somewhere in the world agreed on. That's it.
And what drives that auction? It's the simple, beautiful law of supply and demand. If some good news comes out and suddenly more people want to buy a stock than sell it, the price gets bid up. If bad news hits and everyone's trying to sell, the price goes down. It's all happening millions of times a second, matched by supercomputers, all reacting to the constant flow of new information.
Okay, so you know what a share is and you know why its price moves. The next logical question is, great, how do I actually get one? Where do they even come from?
This is a really important distinction to understand. You have two markets. First is the primary market. This is where a company creates brand new shares and sells them for the first time in what's called an initial public offering, or an IPO. When that happens, the money goes directly to the company to help it grow. But after that one event, all the action moves to the secondary market. This is the stock market we see on the news every day. Here, investors like you and me are just trading those existing shares amongst ourselves. When you buy a share of Demat today, your money isn't going to Demat. It's going to the person who sold you their share.
Now, to actually participate in this market, you need a specific 3-part setup. You've already got the first part, your regular savings account. That's where the money comes from. The second piece is a Demat account. Think of this as a digital locker or a vault where your shares are stored safely and electronically. And the third piece is the trading account. This is the app or the website your broker gives you to actually hit buy and sell. All three work together behind the scenes to make it all happen.
All right, you get the concepts, you've got the accounts set up in your mind. Let's zoom right in on the daily beat of the market. What actually happens from the opening bell to the close and beyond?
A trading day has a very specific rhythm. It kicks off at 9 a.m. with a short 15-minute pre-opening session. This is where the market absorbs all the news that happened overnight. Then, at 9:15 a.m. sharp, regular trading begins and it's on until 3:30 p.m. But it doesn't totally stop then. After the market closes, you can still place what are called aftermarket orders, getting your trades ready for the next morning.
And this brings up a question that puzzles almost every new investor, right? You see a stock close at, say, 100 rupees one afternoon, and then the next morning at 9:15, it opens at 105. How is that possible if the market was closed all night?
The answer is in those aftermarket orders we just talked about. Let's say a company announces amazing profits at 8 p.m. All night long, investors are placing buy orders. All that pent-up demand builds up, so when the market does its first calculation in the morning, the price gaps up to reflect all that new interest. The market is always pricing in new information, even when it's technically shut.
So you hit buy. Do you own that share instantly? Well, not quite. There's a behind-the-scenes process called T+2 settlement.
T stands for the day you made the trade. On that day, the money is blocked in your account. Then it takes 2 more business days, T plus 2, for the exchanges to do all the paperwork, verify everything, and officially deliver the shares to your Demat account. So on that 3rd day, you are the undisputed legal owner.
All right, for our last section, let's zoom out one last time. Because the market isn't just you, a computer, and a stock price. You're in there with millions of other people. And the companies themselves can do things that directly impact your investment. These are called corporate actions. For example, a company might share its profits with you by giving you a cash payout, called a dividend. Or they might give you free extra shares, called bonus shares. Or they might do a stock split, where they, say, turn your 1 share into 2, but cut the price in half. It doesn't change the total value, but it makes the stock look more affordable to new buyers.
Now, on that dividend point, here's a super important rule to remember. Let's say a stock is trading at 1,000 rupees, and it announces a 50 rupee dividend. On a specific day, called the ex-dividend date, the stock price will automatically open about 50 rupees lower. Why? Because anyone who buys the stock on or after that date doesn't get the dividend. That value has literally been paid out, so it's removed from the share price. It's not a crash, it's a mechanical adjustment.
Finally, who exactly are you sharing this market with? Well, it's a real mix. You have retail investors, that's probably you and me. You have high net worth individuals who have a lot more capital. But the real heavyweights are the institutions. You have domestic institutions, which are Indian mutual funds and insurance companies, and then you have the foreign institutions, which are massive global funds investing in India from abroad.
And knowing about these players isn't just trivia, it's super practical. When you see on the news that foreign institutions, or FIIs, are selling heavily, you know to expect some big swings, because they move billions. But on the flip side, you'll often see that domestic institutions, or DIIs, step in and start buying when prices drop, which can act as a stabilizing force. It helps you understand the story behind the numbers.
And that's a wrap. Just take a second and look at everything you've just learned. We went from that confusing spaceship to understanding what a share is, the mechanics of how you trade it, the structure of the market, and who all the players are. You are now absolutely ready to open your accounts and actually understand what's happening on your very first trade. So, you've just mastered the how. You get the plumbing, the nuts and bolts of how this giant machine works. But the real adventure, the real art and science of this whole thing, starts with the next, much more interesting questions. What companies should you actually buy? And even more importantly, why? Answering that is what takes you from being a participant to being a real investor.